and be heard, which is fantastic. G'day, mate. How you doing?
The absolute magic of changing the room that you've got your office into this morning, and then realising that the Wi-Fi wasn't quite working properly. So, hi folks, hello, and Alexi, a special hello to you as well too. So hopefully we can we can cover off a couple of the points that you've asked about. I'm going to start, and I hope everybody can see that chart in front of you there. Okay, it is a chart of the US Treasury bonds. So why are bonds, which some people view as possibly the most boring market on the planet, the most important? Well, it's the most important simply because they're the biggest in the world. Okay, interest rates dominate everything. Long-term interest rates tell us so much information. Jeff, small point, we get onto that, hopefully answering that question we were discussing earlier later on. So when we look at the chart, what is happening? This is a weekly chart of the US 30-year Treasury bond yield. And as you can see, as I'm staring across it, I will put my glasses on at this point because then I can do it without looking a bit weird and going off screen to do it. As you can see, we have been in rally mode. So yields have been going up, prices have been falling. Perspective-wise, if you're a bond trader in any of the G7 markets this year, it has been a nightmare for you. It has simply been the worst year in the bond market since I've been in the business, and I've been in the business a very long time, back into the 1980s. There has not been a year like it. If you are this sad and unfortunate owner of 50-year gilts, you have lost 70% of the value. It begins to look a little bit like a tech stock some days. What does that mean? It means that interest rates, so as the price comes down, the interest rate goes up. So you've got a much higher interest rate today than you had 18 months ago. In fact, even less than that, even 9 months ago. A significantly higher interest rate. What does that mean? Well, if you think about it, when you look at the stock market in the States, we all know that the stock market in the States doesn't pay many dividends. There aren't many big dividend paying companies there, are there? It's all about growth. When we think about the NASDAQ, we think about growth, capital growth, the great idea, the new business. We know the story. Okay, so that has, if you think about it, because it doesn't pay you any money back. Okay, what you're relying on is the growth of that stock to go up and up and up. So the business idea to be incredibly successful. To do that usually requires money. When money is cheap, those stocks tend to do very, very well. Why? Because it's just obvious. You can borrow money cheaply and you can invest it in a great idea that then becomes a fantastic business idea, which then becomes a great, an amazing business idea. Think electric cars or perhaps Facebook, although there may be a few people that own Facebook who disagree with you this week. So the point about this is, as interest rates go up, those ideas become a little bit more tricky. Now we need additional performance, not worse performance. We need much better. We need the idea to be even better. Why? Because it costs more money to fund it. Okay, so that's why this long-term interest rate that you're seeing on the screen is absolutely critical. So as that goes, so will go the stock markets and the equity markets in general and the investing environment. For those who are sitting here today in G7, I don't need to tell you about what's happening to house prices around the world or what's happening to some tech stocks around the world. We've all seen what's happened to Cathie Wood's ARK fund. It's lost like 90% of its value in the course of the last 12 months or so. Tech is dead, which it isn't, but at the moment it's not the right place to be, or hasn't been the right place to be. We'll think about that in a minute. So let's look at that bond market and see what's been going on. Look at the momentum. The momentum and the trend matched each other up until recently. This is a weekly chart. So if you go and think about what's been going on, as the yields have risen very quickly recently, in the US, what you've seen is that momentum start to diverge. Okay, now is that the sign of a top? Well, who knows? I can't tell you whether it's a sign of a top, but what I can tell you is that sentiment is appalling. Sentiment is appalling in the stock market. Sentiment is appalling when you pick up a newspaper and read about the housing market, apparently it's about to collapse. Sentiment is appalling in the bond market. There's nothing but bearishness. Interest rates are going to go up forever. Okay, maybe short-term interest rates are going to rise a little bit. You know, central banks have got to fight this thing called inflation, because as we all know, despite the fact that every single piece of leading economic data is telling you that inflation is done and it's coming back to 4%, possibly 3%, I don't know, across the most jurisdictions reasonably quickly. Okay, what you're seeing is central banks who got it wrong at the beginning, who got it wrong when they started to raise interest rates because it was the wrong time. It almost like when they started to panic, the inflation almost just topped out at that exact moment. So when we look at the bond market, let's go and drill into it a little bit and try and look at some of the dailies and try and see what's been happening here. Okay, for the last 2 weeks, 10 days, okay, the bond market has started to behave a little better. So yields got to about 4.30 on the long bond, and now they're back to what, 4%, I believe now? Yeah, about 4%, closed below it on Thursday, came back a little bit on Friday. They closed below it on Thursday after like 5 straight days down in yield, up in price. Okay, for those of you that look at the TLT, which is the 30-year bond index or the 20-year bond index ETF in the States, you'll have seen that's gone from 170 to the mid-90s. Okay, that is wealth destruction on a grand scale. Does it represent value? Well, I can't tell you what's going to happen next. Nobody can. But what I can tell you is, as you look at this, okay, as those interest rates have started to come down, what's happened to stocks the past couple of weeks? What's happened to the dollar? What's happened to all of those assets that were trading in line with that rise in US interest rates? They've all come to a point where they've started to have a bounce of a kind. Lexi was talking about this, right? At some point, the sentiment gets so extreme that people just can't ever bring themselves to be involved in it again. And I really feel when you look at the headlines, we're seeing the sentiment extremes. I've talked about this over and over again. For those of you who have listened to me for the past 4 or 5 years, you've been incredibly patient. But the one thing I have said consistently all the way through this, if you walk back a year, I said sentiment in stocks was extreme to the top side. Unbelievable. We've never seen anything like it. Sentiment and a lot of other assets were sitting in the same place. Today, as we see this, bar 1 or 2, this little bounce that we're having here, sentiment is the exact opposite in many parts of the stock market. If you're in the tech sector of the stock market, sentiment is an extreme low at the moment. Prices are at an unbelievable collapse compared to where they were. So is that interesting? Well, I always get interested when people are getting very, very, very negative about things. Why? Look, it's just sort of, to me, I see when crisis hits, that's when opportunity strikes, right? There's opportunities for you to be involved. When everybody else is buying, do you want to be buying? No, you want to be thinking about buying when everybody else is selling. You will not get the bottom price. It just is, you know, you'd be lucky. Brilliant if you do. But the key thing here is identify that sentiment extreme, then go to your charts, then have a think about what that means, and then that will be the wind at your back of your trade. So when we talk about the anti-trend trade that Lexi was maybe alluding to a little earlier, when it's going to happen, I'm already seeing it starting. Okay, I'm already seeing it starting in stocks. I'm already seeing it starting in bonds. I believe we've made a turn. Does that mean to say that this is the end of the rally in yields? Well, I can't tell you that. It just begins to look like it. Next week, if the technical picture deteriorates, I may have a different view. But for the time being, what I'm seeing of those sentiment extremes is a potential reversal in the euro, a potential reversal in dollar yen, potential. And dollar yen's probably the weakest one of the lot, actually. I'll go into that in a second. When you look at the Swiss franc, when you look at the Aussie and the Kiwi, you know, the Kiwi's got down, I think, to 55. The Aussie got down to the very low 60s. These are levels which are quite extreme from a sentiment perspective. Again, is it the low? I can't tell you. Is it a sentiment extreme? Are people particularly negative about those currency pairs? Yes, they are. So when you see an extreme in sentiment and you see a technical backup to your trade, then sometimes those trade reversals work. Why are they so attractive? They're attractive because on a risk reward basis, they've moved super quick, super fast, and super distance. Okay, we can look at what's happened to the euro. The euro, I believe, got down to, was it 95 on the low, guys? I can't remember the exact low point, somewhere around that. Where are we now? We got back to par even, right, to one even, almost in what, a week, 10 days, something like that. Okay, these reversals are there and they're great trading opportunities. So just have a think about that sentiment and where you want to pitch it. And for those of you that have missed out on this, just read a newspaper from time to time. Try and pick up this idea about how people are feeling. Go on Twitter. I just do a straw poll of 10 people on Twitter who comment on financial markets and see where they sit. Okay, when things are bleakest is the time when the opportunity is there. Okay, right, that now having been said, let's dial into a couple of things. So, what's happening at the moment? It's the end of the month, right? Well, does that make a difference? Well, in October, of course it does, because every October, from trading day 18 to trading day 22, the end of October, there is a 90% of the US stock market rallying, a 90% probability of the US stock market rallying. So what has happened? Let's go and look at the US stock market for the last few days. We'll kill the momentum chart. Let's just go look straight at this. Okay, here we go. This is day 18 here, I believe. Or is it here? I can't remember which one. Look at what's happened the last 7 days, right? This is coming into month end. Okay, the market's up again, yet again. So this is almost a 97% chance now. When you go back and look at the previous 30 years of data, the market tends to rally at the end of October. Why? Can't tell you. I don't know. Who knows? Who cares? Okay, you're looking for 90% trades, guys, out there. Do you have that sort of success rate on your trading systems? Well, some people do, some people don't. Here's one that's been working for quite some time. This is out there in the market. There's lots of people talking about this. It's not as though it's unknown. Okay, so this is a known signal. There's another one coming up at the end of the year. Is this working at the moment? Well, quite clearly it is. Is it going to work on Monday? I can't tell you because I don't know when Monday's going to hit tomorrow. We'll all have a look. But when there's a bias for the market to rally, what does that do? At the same time as this, you've had a rally in those treasury bonds. The yields have fallen, price is up. Okay, so then the stock market has the wind at its back. So question, is this going to continue? Is this a dead cat bounce or is this something more serious? Well, here's the thing. We're walking into a Fed meeting next week. There was guaranteed 75 basis points if I walk back 7 days. Now, all of a sudden, the economy is starting to deteriorate. What I'm seeing now is people begin to talk about only 50 from the Fed. Or language after they raise 75 that they're going to start to back off. Imagine what the Fed starting to back off would do to asset markets generally. Imagine what people's attitudes are at the moment. With everybody being so negative, ask yourself this question. What are people's positions today? If they're so negative, would they be super long of stocks or would they be out of stocks? If they're so negative, will they be super long of bonds or will they be out of bonds? If they're super negative, will they be super long of the Aussie dollar or will they be out of the Aussie dollar and still in the US dollar? So imagine the sentiment shift on the back of a nuanced Fed speak. Doesn't have to be an action. It just has to, for him, has to say, but. That's all we need to hear next week. Okay. Jeff, I'll leave it there. I've taken too long already. Any questions that anybody has?
Mate, I'll wait on those questions most certainly, but love it when you talk like this. This is my kind of season, if you like, when those markets are looking to turn. And I think we've got a common theme here already. Alexis has touched on it. You've followed through. And let's see if that pans out in the next week.
Yeah. Hey, thanks, Jeff. Hey, look, one quick thing. Am I allowed to do a little 2 seconds more here?
Of course.
Okay, right. Dollar yen. Lexi, dollar yen. Right. Now, when you look at this chart, okay, this goes back to, I don't know, I've got 82 on my chart, right? So it goes back a few years, right? I also looked at the British pound for the record as well too, and I remember the last time it was trading at these levels, and then I looked at the date, so I didn't put that chart up because I'm not going to tell you how old I am. So anyway, right, when we go through this, okay, something I want you guys to bear in mind, right? Here is the chart of Oh, don't do that. Hang on. Let me just see if I can just grab this line. This is the chart of dollar yen, and my mouse is not going to behave. Here we go. Here we go. Right. I'm going to do this. That distance there, in terms of price, was done in terms of time. Perfect wave one. If anybody's into Elliott wave, you'll know what I mean. So perfect wave one, wave two. Okay, so price and time equaled each other. Okay, now we're in something different. For those of you that think about the sentiment cycle and the way we look at it, I'm going to pose something here. Are we at the breakout point? Have we reached the aversion point down here in this area where my mouse is? Let's try and make some colors down here. Well, let's just put a straight line on this. There we go. This area here. Was that the aversion point, right, for dollar yen? In which case, if it is, where's dollar yen going to? Because to me, it looks like an accelerating chart. By the way, for the record, guys, this is a quarterly chart. Okay, a quarterly chart. So in actual fact, if you've been dollar yen, you can be long of dollar yen for almost 2 years, right? But this to me looks like an acceleration. It doesn't look to me like a market that's going to top out here. Could be wrong because it's a quarterly chart. Okay, I could be wrong. But from a technical perspective, when I look at this, my old friend, I did say this about 5, possibly 10 years ago, Ainsley will be able to prove me right on this, that it was going to 250, and it was a standing joke between her and me that she kept on saying, how's your 250 looking, for years and years and years. Funnily enough, laughing less now, not at my level yet, but it took a little while for me to get coffee up to where I wanted it to be. Anyway, so that I see when I look at dollar yen, trouble ahead. I'm not quite sure why it would ever go any higher than where it is now. It's already pretty weak on a year-on-year basis. So is it done? Quite possibly for the year, I don't know. And there may be something on the daily patterns that you can pull out, Lexi, that I'm not seeing. But I think there's a potential top in there, but it's got to be proven. And even if it is how long is it going to last for? Because this to me looks like a pretty accelerating curve. Something has to break. If the Japanese will not break their bond market, then the currency is going to break. Okay, so, you know, trading wise, for those of you who are thinking about this, there's a short JGBs, long dollar yen thing going on here, right? And you choose your poison, right? Who's going to blink first, the government or the foreign exchange market? So I don't know. There's something in there, right? And I don't advise people on what trades to do, but you get the hang of what I'm thinking. So when I look at this to me looks like it's got a little bit further to go. If that was a genuine wave 1, wave 2, then wave 3 is going to be a little bit bigger. We're on our way, believe it or not, we're on our way to north of 200. I don't quite know what's going to cause that, but crikey, that sort of suggests something quite serious. But anyway, we won't talk about that now because that's not for today. But so I hope that helped you on you asked me about dollar yen. So, okay, cool. Right.
Mate, that does certainly look like a chart I've seen 100,000 times before, especially when you do one of your presentations, I've got to say. But if we're on the yen, and look, I know we've got people waiting to go, but we don't get to see you often, so let's take advantage of that. I was asked a question by a mate of mine, speaking about the yen, and he asked me if Japan's debt to GDP ratio is 230%, which it is, and the US debt to GDP ratio is about 120%-ish, around there somewhere. How is it that the US inflation is circa 10% and Japan's is circa 3%? I won't tell you what my answer was. I'd much prefer to hear yours.
Yeah, I love it when you pose these questions to me, Jeff. So, okay, context, right? For everybody that doesn't know about what debt to GDP ratios are, this is the amount of debt that the country has versus the amount of GDP, so the amount of its economy, the amount of value its economy has every single year. So a so-called normal in a standard debt environment would be somewhere between 30 and 80. At 120, you can make a decision that probably you borrow quite a lot of money. At 260, you can make a determination that you've borrowed so much you don't know what to do. So they have a decision point in Japan. But why isn't inflation feeding through? Well, Japan has a demographic problem. It has a deflation problem. And all that's happened recently is that one sector of the economy isn't performing that well from an inflation perspective, which is the cost of energy, right? That's a worldwide problem. And for those of you that haven't read a newspaper in the last 4 months, please go and look it up. There may be something going on in the energy markets. I'm sure you're aware. You don't need me to rehash that, right? Complete carnage and remarkable times for that sector. So what is going on in Japan is that they've isolated themselves for a lot of the inflationary effects because they have not been as expansionary from a fiscal perspective as the Americans have. So what the Americans have done, somebody described it to me the other day. They said if you look at the combination of fiscal and monetary policy that the Americans enacted during COVID and put really in 2021 with various pieces of government legislation, they've actually done something which is 5 times more expansionist than any other previous economic time that they've been in. Okay, so that means to say the combination of the policies have essentially generated 5 times as much, not growth, but 5 times as much activity in the economy as they've ever had before under any previous government since the Second World War. So think about it as an extraordinary accommodation. Is it a surprise, therefore, that inflation's up, that nobody could get hold of anything, that goods volumes are through the roof? And we've then had all the consequent problems that have happened because of that. And now we've got the opposite. Now everybody's bought everything. Now there's no more government support and they're raising interest rates. What do you think's happening, right? So you take that 5 times expansionist policy and then you collapse it in the space of 12 months. What do you think is going to happen? Funnily enough, underlying the economy is a lot of inventory overhang, and already you're beginning to see deflation, a lot of commodity markets and all that other thing. So, the key point is that's why the US inflation was driven higher. It's a lagging indicator of inflation. It's lagging and sticky. And that's why it got driven higher, because Japan just didn't expand as much. And because of the way that their economy is managed and they're thinking about, so think about this, right? They always have a deflationary impact of about 2 or 3% every single year as an overhang. For them to get to 3% inflation is awesome. Right, but they've got to it the wrong way. They've got to it through energy price increases, which doesn't make anybody any richer. It actually is more disruptive. So I hope that helps answers your question, Jeff. One little addendum on the end of this that I will say is that it doesn't matter what your debt to GDP ratio is. What really matters is the shape of your yield curve with a debt to GDP ratio. What matters is whether you can finance this stuff, right? So if nobody believes you, right, then that yield curve steepens. Okay, long bonds yield a lot more than the front end. At that point in time, then you have a problem. Until that happens, the world is fine. Borrow as much as you want.
Including borrowing more to pay your debt, right? Which is what the US
exactly. Well, I believe most of the JGBs in the world are now held by the Japanese central bank.
Interesting. More than interesting. Mate, that wasn't my answer, of course. Mine was far more abridged and less information in that. But thank you very much. Really appreciate it. My mate will be very, very happy. You've got a course coming up next week for those in the mentorship group who are eligible. I have, yeah. I urge you to attend. What's it about, Jules?
So we're going to cover quite a few topics, actually. In fact, I'm going to be interactive. For those of you who are in the eligibility category, you will get an email from James, I think tomorrow. James and I are working on that script tonight. And I'm going to ask you what your favourite 5 topics are, and we're going to go through it. So it's almost going to be like a Bruce Springsteen concert. We're going to stand there, and you're going to ask me what you want me to talk about, and I'll talk about it. There's about 7 or 8 topics, and you're going to get the best 5. So what I want to try and do is whatever's focused to what you think is your biggest problem, your biggest opportunity in trading that you need help with at the moment. And we'll go through it. The one thing I won't be doing is telling you what to do and when, right? This is about you developing as a trader. What are the things, the tools you need to develop as a trader, and how can I make you better as a trader and go on to be profitable and successful? And I'll hopefully see you guys next Sunday.
We'll be headlining all the traders turning up at Bali. Again, if you're in that mentorship pathway and eligible to go to Bali, be there. Just be there. That's all I can say. Julian, thank you so much for your time, mate. Really appreciate it. And we'll catch up later, eh?
No worries. Cheers, guys.
See you, mate.